Welcome, viewers. Today it's Tim and Felix on a wet and cold Friday morning. Tim, how about you share a bit about something about yourself for those viewers who don't know too much about yourself at this present moment?
Yeah, hi, thanks, Felix. My name's Tim. So I work as a mortgage broker based in Sydney. We kind of fund loans all up and down the east coast of Australia. So Brisbane, Sydney, Melbourne. What about you, Felix? Can you introduce yourself as well?
Yeah, so Felix, based in Sydney, but work as a property expert and buyer's agent. Our focus is predominantly investors, focus heavily on the niche market of looking at ways of manufacturing equity. But look, we look up towards Brisbane, Sydney, and Wollongong as well. And, our focus is just to really get people building wealth for the next generation. But look, Tim, we were speaking earlier, and there's been a lot happening in the news lately with regards to fixed rates increasing with CBA, and there's been a lot of focus and concerns what that would mean from a repayment point of view. And we were just discussing that, a lot of people do just think about what that means from a monthly base, but no one kind of talks about strategies and tips in which you can actually reduce your mortgage as opposed to worrying about what that increase will look like. So today we really want to kind of dive in, understand your knowledge and your expertise in terms of what you do for your clients. I know you shared a couple of stories earlier, so I'd love to really kind of share that with the rest of the people listening. But yeah, today we're just going to really just look into some simple logical strategies that you can use today, which will help repay your mortgage down sooner. So Tim, mate, love to hear what you've been kind of obviously helping your clients out with. Go for it, buddy.
Yeah, so thanks, Felix. So, recently, as you mentioned, a few of the majors have started to raise their interest rates. We've seen numerous rises in rates, within the last couple of months, which is pretty unheard of, but it has started to scare a few people, and it makes them wonder, like, will my contractual minimum monthly repayment be manageable? In Sydney, particularly, and in the Melbourne markets, where we're seeing the average loan size increase quite dramatically as property prices rise, this can be of particular concern. So it's been sort of a fundamental thing that we've tried to explain to our clients, that there are ways that you can actually manage to pay your loan down a little bit quicker, so that you're not stuck with something for the whole 30-year term.
Yeah, fantastic. And like you mentioned a few key strategies earlier, but the one that really intrigued me was using your credit card. So maybe you could share a bit about that.
Yeah, absolutely. Look, the majority of loans that we're setting up at the moment for both owner-occupiers and investors usually involves the use of an offset account. So the way that an offset account works in a nutshell is that any money that you have in that offset account, which is fully transactional, will basically offset the interest payable on your loan. For example, if you have a $500,000 loan and you've got $250,000 sitting in your offset account, you'll essentially only pay interest on half of your loan, because half of it has been offset. So what we were discussing previously was that the idea, or what we try to express to customers, is that you should have the maximum amount of money possible in that offset account for the longest period of time possible before you spend it. One of the ways that you can do that is by using a credit card to pay for your day-to-day groceries, fuel, all those kinds of things. So when you take out a package loan with a lender, which is usually what you need to do in order to get access to an offset account, they'll offer you a credit card if you don't already have one. And you can use that credit card to take advantage of that tactic that I just mentioned, where you buy your goods and services on credit rather than with cash. The one thing that people have to be very careful with is, obviously, interest rates on credit cards is a lot higher than interest rates on a mortgage. So if you're not making your repayments on time with your credit card, you actually lose that benefit, because you'll be paying a lot of interest for late payments on your credit card, which is also not great for your credit score.
Yeah, so I guess if you are diligent with your money and your finances, then you can really benefit, not only to gain points off your credit card and put that towards a flight or a holiday, but you could also look at ways in maximizing or reducing your interest payments on a monthly basis. But I guess that's where you would have to be very, very diligent with your spending and your habits. I would assume.
Yeah, absolutely. And that's a good point that you make there, that you obviously do accumulate points through many credit card programs as well. So it's kind of like a double whammy. Not only are you extending the period of time that your money's sitting in offset, but you're also getting that benefit of using points. And whether you use those points to for flight travel or to buy things at the shops, sometimes you can even get cash back. You can fund your points in and get cash back to pay your credit card down as well. So like it really is, if you can manage your money well and make sure that you're meeting your monthly repayments with the credit card, it's a great tactic to paying your mortgage down a bit sooner.
That could be another session we can do in a podcast, how to obviously manage your money and,
absolutely
look at ways to ensure that you've got your expenses and your spending right, so that you do have the capacity to pay down not just the minimum on a monthly basis, but the whole amount, so you're not accumulating that debt. But that's great. Talk to us around like different frequencies in repayments. Obviously the standard is monthly, but there are other frequencies that people can opt in for.
Yeah, absolutely. It's a great point, because oftentimes people will set their repayments up to more or less match when they get paid from their job. So for example, typically the most common repayment frequency that we see is monthly. But there are other options, like you can opt to pay your mortgage fortnightly. And there's a different version of fortnightly repayments known as accelerated fortnightly repayments. So what that means is that if you have a $2,000 per month repayment, a fortnightly repayment would be $1,000 per month. So you can basically half the cost of your monthly repayment down to $1,000. The benefit of doing this is there's 26 fortnights in a year. So instead of paying back $24,000, which would be 12 months by $2,000, you're paying 26 times 1,000. So essentially each year you're accelerating your repayments by a month. So as this compounds over the loan term, this can take like a couple of years, 3, 4, 5 years, depending on what your minimum monthly repayment is and whether or not you're using an offset. It can reduce your loan term substantially just by changing from a monthly to a fortnightly repayment.
Yeah, so I mean, very simple, logical steps that anyone can take right away. You don't have to obviously, fill in I would assume any application forms. So I mean, obviously, actually, you wouldn't you? You'd have to obviously apply to the bank to change that.
Yeah, good question. So changing your repayment frequency with some lenders, it can be done over the phone by the customer themselves. Other times your broker can help manage it for you. It usually is typically just a 1 or 2 page form. Very simple change to change your repayment frequency. The one time it can be a little bit more challenging is if you are in a fixed rate loan. But even with that, some lenders, even if you're fixed rate, they'll let you adjust the frequency of your repayments as well. You've just got to check to make sure that you're not changing anything contractually, because that could result in having to pay a break fee.
Yeah. So look, two really just simple tactics and tips that anyone can do straight away. What are the impacts of that would be for a client if they utilize both those strategies immediately over a long period of time? Yeah,
look, it's ultimately the bottom line would be is that you'd have a reduced loan term. So you wouldn't be paying for your mortgage over a 30-year period. You'd be finished paying your mortgage before that. And that means that you're going to save on interest. So that's the big thing here. You're saving on interest, and interest is essentially profit for the bank. It's not money for you. So, I mean, and that takes me back to the use of an offset account, because what happens with the use of an offset account is your contractual monthly repayment doesn't shift. What shifts is the balance between interest and principal that you're paying. So you'll still be paying $2,000 a month, but more of that $2,000 will be principal as your offset account fills up. And what that is it's essentially, it's equity, it's like forced savings, it's money that you'll have access to when you either sell the property, if you want to do an equity release or a cash out or a top up. So you're not losing that money in interest. It becomes yours and it's invested into a real asset, which is a good place for it to be.
Yeah, so I guess just to sum it up, if you really wanted to take advantage of those two strategies that Tim's mentioned in terms of utilizing your offset account whilst obviously spending on your credit card, that's pretty much straightforward. You wouldn't have to actually apply for anything. You would have all that set up. If you don't, I would assume you could speak to the bank or your finance lender and ask about those facilities. But yeah, and then the other step would be to change the frequency, which will then overall impact the life of your loan. And, obviously any money saved is money in your own pocket, which Absolutely. Is fantastic.
Yeah.
What would you say would be three or one or two key takeaways out of this conversation for people who are a bit more concerned about possible rate increases over next year. And obviously we talked about how to manage your repayments so you can pay it down sooner.
Yep.
Is there anything else you'd like to share just for those people listening?
Yeah, absolutely. So if cash flow is a significant issue, and if it's something that you're highly concerned about, it's definitely worth considering paying for a rate lock facility. The way rate lock is calculated is different between the lenders. Some lenders charge a fixed fee and others charge a percentage of the total loan that's going to be funded. Other than that, the things that we've talked about today, for example, paying more than your minimum monthly repayment is one thing that you can do. Switching to fortnightly repayments, as we discussed, and then of course number 3, using an offset account and potentially coupling that with the use of a credit card. Those are really, in terms of paying your mortgage down sooner, managing cash flow, getting on top of your finances, those are probably 3 things that I'd say would be key takeaways from our discussion today.
Awesome. And like we mentioned, I think there's definitely another session that has to be had with regards to managing your money. So people who are looking at utilizing that credit card facility for those benefits, we can really drill down and obviously give you an ideal understanding how to obviously track all those funds usage, so you're not having to feel overwhelmed. So I think sometimes when you are using a credit card, that could be the scary thing. But yeah, absolutely. Love it, Tim. I think it's just been really great that we've been able to share and obviously being able to empower all the people, because obviously I would say 99% of the people in the population have a mortgage. So it's something that everyone needs to be more kind of aware of. And it's great.
Look, thanks. Yeah, thanks, Felix. Great discussion. And I think as well, next time, like for those who are interested in this topic, we're going to do a part 2 to this as well, which will be Felix explaining how he, as a buyer's agent, has seen customers able to reduce their mortgages in larger lump sum figures by investing and leveraging off potentially their existing homes or their existing properties and doing investment projects that result in good profits that they can then funnel into paying their other facilities down.
Yeah, absolutely. Sounds good. Looking forward to it.
All right, Felix, good to chat on this topic.
Take it easy, buddy.